I want to start with a simple question. What if America's trade war wasn't really about trade at all? What if the real battlefield was something far quieter, far more powerful? The US Treasury market. On the surface, tariffs look straightforward. Raise taxes on imports, protect domestic industry, collect more revenue. But beneath that logic sits a hidden cost, one that doesn't show up on receipts or campaign slogans. It shows up in bond yields, in mortgage rates, in the price you pay for a home, a car, or simply borrowing money to live your life. Trump's protectionist push created a short-term fiscal cushion, but it also injected long-term uncertainty into the financial backbone of the United States. And here's the uncomfortable truth. When treasuries move, everything moves. If this sounds abstract, stay with me, because by the end of this video, you'll see how trade policy quietly reaches into your wallet without ever calling itself a tax. If this kind of hidden connection matters to you, make sure you're subscribed. Now, let's step back and define the problem clearly. Let's slow this down and put structure around the question. At the center of this story are two systems most people never connect: trade policy and government borrowing. The United States runs a large budget deficit. That gap is filled by issuing Treasury bonds. Those bonds must be bought by investors, institutions, and foreign governments. Tariffs enter this picture in a subtle way. They raise revenue. That revenue slightly reduces how many bonds the government needs to issue. Less supply, all else equal, means less upward pressure on long-term interest rates. But that's only one side of the equation. Tariffs also raise prices. They affect inflation. They shape growth expectations. And they influence who is willing to buy US debt and for how long. So the real question is not whether tariffs work. It's whether they stabilize or destabilize the financial system that underwrites the American economy. To understand that risk, we have to look backward at deficits, at bond supply, and at how today's trade policy collides with a very different fiscal reality than the past. And that's where the story truly begins. To understand why today feels different, we have to rewind the clock. For decades, the US ran deficits, but at a manageable scale. From 1980 until the pandemic, deficits averaged around 3% of GDP. Markets absorbed that debt without panic. That world no longer exists. Today, the deficit sits closer to 6% of GDP, roughly double the historical norm. And structurally harder to reverse, bigger deficits mean one thing: more treasury bonds, issued more often, in larger volumes. That would already be a challenge on its own. But now, add tariffs. Under Trump, tariff rates surged to levels not seen since the 1932. That shift created a burst of customs revenue, hundreds of billions of dollars almost overnight. On paper, it looked like relief. More revenue, less borrowing, a fiscal cushion. But history tells us something important. Temporary revenue streams are dangerous foundations for permanent spending. Because tariffs are political, they can be reversed, struck down by courts, or offset by new spending commitments. And when that happens, bond markets react fast. Expectations shift, issuance forecasts change, yields move. What once felt like stability starts to feel fragile. And that fragility would soon show itself not in theory, but in real markets with real consequences. That moment came suddenly, and it rattled investors. It happened faster than most people expected. In the summer of 2023, the Treasury Department announced it would need to issue more debt than markets had been prepared for. Not because of a crisis, not because of war, but because fiscal math had quietly shifted. Investors noticed immediately. Then came the second shock. The US credit rating was downgraded. That single moment did something powerful. It changed perception. Long-term Treasury yields surged toward 5%. Equities fell sharply. Borrowing costs jumped not just for Washington, but for households and businesses across the country. This was the first real warning shot. It showed how sensitive the system had become to changes in bond supply, how little margin for error remained, and how quickly confidence could turn into volatility. Tariff revenue, which had been quietly supporting deficit math, suddenly looked fragile. What if courts struck tariffs down? What if new spending erased the gains? What if bond issuance had to rise again fast? Markets began to price those questions in real time. And here's the key insight. This wasn't about politics. It was about trust that the US could fund itself smoothly, trust that debt issuance would remain predictable, trust that long-term yields, the anchor of the entire economy, would stay contained. If you're finding this perspective useful, this is exactly why this channel exists, because the next risk wasn't coming from supply alone, it was coming from demand, and that's where the story becomes global. For years, the United States never worried much about who would buy its debt. There was always demand from the Federal Reserve, from US banks, from foreign governments that needed dollars to run their own economies. That assumption is no longer safe. Today, those traditional buyers make up a much smaller share of the Treasury market than they once did. The system still works, but it works with less slack. Tariffs complicate this balance. On the surface, trade policy doesn't seem connected to bond demand, but it is especially overseas. Foreign governments hold a significant share of US Treasuries because of trade. They sell goods to American consumers, they earn dollars, they recycle those dollars into US government debt. That loop depends on trust and on stable trade relationships. When tariffs rise aggressively, that loop weakens, not immediately. Quietly, countries begin to rethink supply chains. They diversify trade partners, and over time, reserve managers start asking uncomfortable questions. Do we need to hold as many dollars, as many treasuries, for as long? So far, foreign demand has held up. History suggests it often does, even during trade wars. But here's the risk. If foreign investors want to reduce exposure without triggering headlines, they don't need to sell. They just stop replacing maturing bonds. No crash, no panic, just less demand at future auctions. And when demand weakens while supply grows, yields rise. That brings us to an unexpected new player, one policymakers didn't fully anticipate, and it introduces a different kind of risk. Enter stablecoins. A new kind of demand for treasuries is emerging from the digital economy. Specifically, stablecoins, digital currencies backed by reserves, including US. Treasury bills. The idea is simple. Stablecoins want to maintain their dollar value. To do that, they need liquid, high-quality assets like T-bills backing them. This could drive new buying power into the Treasury market, especially for short-term debt. But there's a catch. Stablecoins aren't like traditional buyers. They don't hold treasuries for the long haul. They may want T-bills for their liquidity, but they only hold them as long as they need to. And the market for these digital assets is volatile. If stablecoin issuers face a liquidity crisis, say a run on the bank or a collapse in trust, those T-bills could flood the market. And the ripple effect? Higher short-term yields, tighter liquidity. Even if that doesn't happen right away, the question remains, can the Treasury market withstand the waves of demand from a volatile digital asset class? The rise of stablecoins is one of the most underestimated risks to the Treasury market, because while they're still small in comparison to traditional buyers, their growth is explosive. And the world doesn't fully understand how they'll impact everything from yields to the broader economy. In the longer term, these new forces, both digital and global, pose risks. And with a shrinking pool of reliable buyers, the risks of higher long-term yields only grow. It all comes back to this. If the Treasury market falters, it isn't just a US problem. It's a global one. Now, let's zoom out. What does this all mean for the people who actually buy bonds? For the everyday investor, the person looking to buy a home, or even the businesses borrowing for expansion, it means higher costs. Bond yields aren't just numbers on a chart. They directly impact your mortgage rates, your car loans, and the financing costs for companies you work for. When Treasury yields go up, borrowing becomes more expensive across the entire economy. Consumers face higher interest rates. The cost of doing business rises. But it doesn't stop there. Rising yields also create pressure on the US government's budget. Interest payments on existing debts soar, eating up more and more of the annual budget. That leaves less room for other priorities, things like infrastructure, education, or healthcare. The economy becomes more constrained not by policy, but by rising debt service. And here's the thing, if the Treasury market becomes too volatile, or if foreign demand shrinks, the US will have to adjust. It could mean higher interest rates. It could mean even less spending flexibility. So, as tariffs and trade policies shape the Treasury market, they don't just impact financial markets. They impact the lives of millions of Americans through higher borrowing costs, constrained fiscal policy, and a weaker global position. What's at stake here isn't just numbers on a spreadsheet. It's your ability to borrow. It's the government's ability to invest in the future. And it's the broader global stability of the US dollar. The ultimate question is whether the US government can preserve the balance between tariffs, deficits, and bond yields. If that balance tips, we all feel it. Looking ahead, there are three potential scenarios for the US economy and for the Treasury market. Uno, best case scenario, trade policy stabilizes, tariffs are reduced on non-strategic goods, lowering inflationary pressure. The US Treasury market remains strong, with sustained demand from both traditional buyers and emerging digital assets like stablecoins. Deficits remain manageable, and inflation is kept in check. Bond yields stay relatively stable, and borrowing costs for consumers and businesses remain low. In this scenario, the US could maintain a solid fiscal position and continue to invest in its future without sacrificing global confidence in the dollar. Dos, middle scenario, trade tensions continue, but tariffs remain elevated. The US faces persistent inflationary pressure and growing deficits. Bond issuance increases as tariffs fail to cover the full budget gap, leading to higher yields. There is a rise in borrowing costs, which slows down consumer spending and business investments. In this scenario, while the US remains a key global player, fiscal constraints may limit its ability to respond to future economic shocks. The Treasury market becomes more volatile, and the country's fiscal policy feels more strained. Worst case scenario, trade wars intensify, tariffs remain high with minimal positive impact on domestic industries. Foreign demand for treasuries shrinks as countries diversify away from the dollar. Stablecoin demand fails to fill the gap, and the Treasury market experiences significant volatility. Long-term bond yields spike, pushing up borrowing costs for the government, businesses, and consumers alike. In this scenario, the US faces a real risk to its economic stability. Fiscal policy becomes a balancing act between higher debt service costs and the need to fund essential programs. The dollar's dominance is threatened, and the government may be forced to make painful choices. The bottom line, what happens to the Treasury market over the next few years will be determined not just by how much the US borrows, but by the evolving landscape of trade policy, global demand for treasuries, and inflationary pressures. US policymakers must be mindful of these risks. They should consider rolling back non-strategic tariffs, strengthening digital asset regulations, and taking meaningful steps toward fiscal sustainability. Without a long-term strategy that addresses these challenges, the US could face a future of persistent economic volatility, and the costs of those decisions will be felt everywhere from Wall Street to Main Street. To wrap this up, let's step back and reflect. The Trump administration's protectionist trade policy has set off a chain reaction, one that, for all its short-term benefits, introduces long-term uncertainty, especially in the US. Treasury market. Tariffs may have helped fill the federal coffers temporarily, but the ripple effects on bond supply and demand, inflation, and global confidence are harder to predict. And this instability has consequences, not just for the Treasury market, but for the broader economy. In the short term, we may see the benefits of higher tariff revenue, but in the long term, that revenue may not be enough to cover rising deficits and could even contribute to higher long-term yields. The future of US Treasuries hinges on a delicate balance. The decisions made today on trade policy, bond issuance, and fiscal responsibility will shape the economic landscape for decades to come. Policymakers need to take these risks seriously. It's time to rethink tariffs, protect the stability of the Treasury market, and ensure that fiscal sustainability is at the forefront of decision-making. Because if we don't, the consequences will go far beyond the financial markets. They'll affect us all. And with that, we close this chapter. If you're looking for more insights into how economic policy shapes your daily life, stay tuned for our next video. Make sure to like, subscribe, and hit that notification bell, because understanding these dynamics could be the key to navigating the future of our economy.